Hello everyone, welcome to a new video. Today we're going to be discussing Rolls Royce's alleged discussions into raising equity. Before we jump into that though, the usual disclaimers apply. This is not financial advice, please don't take it as financial advice. Do your own research from your own opinions before you invest any money. But let's jump straight in. So Rolls Royce, obviously a well-known British company, manufactures cars as well as engines for aeroplanes. That's the majority of their business. And they're looking to tap equity markets to raise funds, including, sovereign wealth funds here, allegedly. GIC, which is the Singaporean wealth fund. Basically, they need this cash because they've been absolutely hemorrhaging cash ever since this coronavirus crisis began. And they're looking to use an equity raise to do this, which is obviously more expensive than gaining debt. But there's so much debt on the balance sheet at the moment already for Rolls Royce that, just adding debt to that is more and more dangerous and they won't be able to cover their interest payments. This is really just a different way to raise financing, a more expensive way. So basically an equity raise enables Rolls Royce to sell equity in some form. It could be convertible debt, it could be normal shares, could be preferred shares paying out a dividend, or offering, a guaranteed payout if they go bankrupt. But as I said, this is more expensive than debt and it dilutes existing shareholders because you're adding to those shares. Now, it's alleged that they're looking at around 2 to 2.5 billion pounds worth, which, is quite large when you consider the market cap for Rolls Royce right now is about 3.5 billion. So that could really, really hurt existing shareholders. So that's something to consider if you are currently a shareholder. That might explain why it's now at a 16-year low in terms of share price. And this was kind of expected. People were waiting for an equity raise from Rolls Royce, but it's about $500 million to $1 billion more than people were expecting. I think the original number was around 1.5 to 2, and now we're looking at 2 to 2.5 billion. Obviously, that's concerning. That means they need a lot more cash to survive than they first thought. So, there are already problems with Rolls Royce. If you look at the balance sheet, its financial position, long-term liabilities are already ballooning beyond assets. Current are a little better. They're virtually in line, which is not obviously ideal, but at least assets are slightly bigger. But when you look at long-term, that's a huge problem. Certainly for someone like me who looks for value as well as financial strength. Obviously, at this price, Rolls-Royce does have some value, but arguably not a lot of strength. And there's a valid question to ask whether or not the company will actually survive without government intervention, which could further dilute shareholders. But this basically shows why they're looking at equity. Debt is going to be very difficult to come by at the moment with such high liabilities already, especially when you consider that they've raised a lot of debt already this year, and they don't want to add on to those interest payments. They don't want to really increase the chance of bankruptcy. Equity doesn't do that in the same way, so it's a better option in this case. The reason that the company has been hemorrhaging cash during coronavirus is its business model. So they sell engines at a loss and then make that money back every time the engines are used. So what that means is that they aren't getting a lot of money up front. They're getting it throughout the lifetime of the engine. Obviously, they haven't flown for months, really, which is really, really bad, obviously, for Rolls-Royce. Look, they had a record loss of 5.4 billion in the first half of the financial year. And all the quarantine lists of them going on in the UK, it's a real problem for them. Bleeding so much cash. Obviously, they need to have that buffer there. Now, they have claimed that their liquidity is quite high at around 8.1 billion, but the market doesn't necessarily trust that number. They have taken a lot of steps to really combat this issue, but the market's still not comfortable where the company is at. The equity raise is apparently being considered for the first week of October, so not that far away. And the board is apparently, really pushing the decision to the last minute. They're unsure about what they want to do. The FT article here mentions that. I think that's a concerning thing if accurate. Obviously, there's a certain amount of whether you can trust that kind of rumour from inside the company, but the board needs to be decisive here. They're talking about taking on a lot more equity, diluting existing shareholders, and they really need to, consider whether that's in the best interests of the company or shareholders, and whether the company will still be able to survive with that or not. But earlier in the week, they discussed that they were looking at various different options, not just an equity raise. So this could just be the current news story. It might move on to something else. I think when you're looking at something like this, it's important to consider whether this will even be enough for Rolls Royce to survive. The company's alleged that their liquidity is at 8.1 billion. They've done cost cuttings of 1 billion this year, which involved cutting around 9,000 jobs and other things. They're reorganising, restructuring the company even more. That's got some investors worried because they really wanted this equity raise to come after. So you could show that the company was restructured, it was in a better place. This is almost a little bit desperate to do it partway through. But they have, gone through certain things. So they have earmarked certain divisions to be sold. You've got the Spanish company that they own, IPT Aero, which is an engine manufacturer worth around 2 billion. They're in talks for a bidding process with private equity firms to sell that. And that might include bundling some non-core assets into that sale to make it more appealing. They're also trying to sell Bergen Diesel, the diesel energy business they own in Norway, but they're struggling to find buyers for that, again, according to this FT article. That's worth a little bit less. And then you've got the other things they've done this year. So they have a £2 billion worth term loan that they arranged in July, which they then said will enable them to survive until 2021. But as I said before, there's a huge cash drain from the crisis. Some of the numbers from analysts are very high, a lot higher than that, which I'll talk about a little bit later. So it's really uncertain if that is enough money. Obviously it wasn't, or they wouldn't be equity raising now. But maybe altogether it would be enough. The company also has a £1.9 billion revolving credit line, but if they tap that, they have to repay it before October 2021. Obviously, they're not expecting the market to have recovered by then, so I think they're trying to avoid that, logically so. They don't want to take that and then be struggling to repay it, especially as recently they were downgraded to junk bond status from investment. They might struggle to refinance any more of this debt, so they do need to be careful on how much debt they take on. Probably that's why they're looking at an equity raise again. Also, they have a little bit of problem in that they are a long-haul engine manufacturer. Now, that's problematic because, analysts aren't expecting long-haul to recover quickly at all. It's expected to be a lot slower. Rolls Royce itself is anticipating that it'll take 5 years to recover. That's mentioned in this BBC article. To reach pre-COVID levels. And that's obviously problematic. They've got to survive on the amount of cash they have. They've got to not turn such a huge loss every half year, every quarter, or they're not going to survive. This article here from This Is Money really talks about how the company is right now, but also talks about an analyst at JP Morgan, David Perry here. He's estimated that there's about an £8 billion hole in the balance sheet that obviously will not be plugged by this equity raising of 2 to 2.5. They think they need at least 6 billion more to survive. Now that's a big number. If that's through an equity raising, that would also obviously completely decimate current shareholders. But they've also said that they think the debt pile will grow to 19 billion by the end of the year, and doesn't believe that what they've currently raised is enough to save the firm. Obviously, that's worrying for any investor. You don't want to hear that from analysts, whether you believe they're experts or not. They have opinions. They do research the companies. And to be honest, they probably have a better idea than most other people who don't know the industry that well. Obviously, there are lots of problems with, analysts, and whether they have to give certain ratings. I think there is some concern that JP Morgan is one of the companies helping to formulate this equity raise, but obviously, David Perry here isn't being particularly optimistic on the future of the company, so that's not a big issue. For me, this is quite worrying. I mean, as again the JPM analyst says, they're concerned that there's a high chance of government intervention. Obviously, that's not good for existing shareholders or anyone who is looking to be a shareholder. You don't want government intervention. It will probably result in a huge dilution for existing shareholders, and could take a long time for that government intervention to disappear. A good few years, 5 years, going off the financial crisis in 2008, 2009. The government also has a golden share, which enables them to veto any foreign takeover attempt to the company. So if they're looking to sell, which, to be honest, at this point the board should be exploring all options, they have to be careful with that because the government can veto it. So obviously that adds another risk to Rolls Royce that most UK companies don't have. For me, I think this is an interesting one. It could be worth an investment after the equity raise if it's enough capital for them to survive. That's very difficult to know, very difficult to predict, but it could be. If it is investable, it will be high risk. It's a bit of a Hail Mary, I think. The company is certainly undervalued at this price, but is, struggling. Analysts are expecting that to pick up again. I think if you look at the, future growth here on Simply Wall Street, it is expected to recover just after a long time. Profitable again by 2022. Obviously, that's a long time. Can it survive that long? It's difficult to know. For me, I'm not going to invest in it at the moment, probably not even after the equity raising, because there's such risk there, because it is a bit of a gamble. But there definitely could be money to be made here, because it's a solid company. Before, it was a relatively solid company before. It has good brand recognition. It's good at what it does, but obviously the debt's a problem. The future's very unclear, and any government intervention would be disastrous for shareholders. So I'm going to stay clear. But as usual, normal disclaimers apply. This is not financial advice. Do your own research, etc. And thanks for watching. Please like the video if you enjoyed and subscribe. Thank you very much.